Hello, everyone. Thank you for having me. The paper is with Leonid Kogan at MIT and Wei Wu at Texas A&M. Wei is here too. Um, Empirical multi-factor asset pricing models provide a reasonable statistical description for the returns in the data. In theory, these multi-factor asset pricing models are often justified by standard ICAPM framework first proposed by Bob Merton in 1973. And those traditional ICAPM theory was built on a new classical setting in which households are marginal investors, and also too much burden is imposed on those households by assuming that they can accurately form long-term expectations and also develop sophisticated dynamic investment plans. However, in reality, we all know investors are not that sophisticated, and a significant fraction of financial assets are managed by institutions, not by households directly. And more importantly, those institutions who make investment decisions, they pursue very different objectives from the households. Okay. In particular, the fund managers, they care about fund flows. Why? Because their compensation is largely determined by their own AUMs. This goes back to this. One of the recent influential paper empirical work document this is by Ron Canio, Stein, and their co-authors in 2018. And basically the idea, but this the AUM is further in turn driven by the fund returns and fund flows. The fact that the volatile fund flow is a big source of risk concerning fund managers is often noted in the financial press already. For example, in an article, Wall Street Journal article on October 13th, 2019, it is reported that the cautious investors pulled out $6 billion out of the stock funds in the third quarter, squeezing and ratcheting up pressure on money managers. So actually in our paper, we dig into the data. We also see the systematic volatility of this fund flow component and the systematic volatility of fund return component. They are really comparable. Of course, the return volatility will be bigger, but they are on the same level. In this paper, we document fund managers' flow hedging behavior, and then also we show its important asset pricing and asset allocation implications. So before going to details, let me first provide you a summary of the results. So we show that the fund flow shocks obey a very strong factor structure, and this one common fund flow component commoves with macroeconomic states, especially with economic uncertainty. And also we show the flow beta. So given this common fund flow, each stock have a fund flow beta. It is priced in the cross-section of stock returns, which leads to a conditional 2 beta asset pricing model, and more importantly, a risk premium analogous to this ICAPM's intertemporal hedging term will emerge even in a purely myopic environment. And also we show the fund managers, they actively hedge against the fund flow shocks by tilting their portfolios toward these low beta stocks. They favor low flow beta stocks. And further, we show that such portfolio tilt will become much more aggressive when the fund's outflow risk increases. Lastly, the net alpha of the active funds is endogenously countercyclical in the model to help stabilize the fund assets, which provide a novel channel for this countercyclical net alpha dynamics in the data. So these are the summary of the results. So now let me introduce the model. Basically, I will focus on just use 2 slides to give you a brief overview of the key elements and the key results of the model. Given the time, I will not be able to go into the details of the model. So So in the economy, you can think there are three types of agents, and they are all myopic. Very simple. They are not sophisticated. They are all myopic. The first type of agents is direct investors who manage their own portfolio directly, including those passive benchmark investors. You can think they are this type, and also hedge funds. And there are also fund clients who delegate their portfolio management to fund managers. Well, fund managers care only their own AUMs. They don't care the fund clients or households at all. So the fund clients move capital in and out endogenously, out of funds endogenously in response to the aggregate shocks, which leads to endogenous fund flows and endogenous fund net alphas in this model. And I want to emphasize these endogenous fund flows are the central link that connects the aggregate shocks, like uncertainty shocks, affecting myopic households and the institutions' asset allocations and asset pricing. Why that's the case? Because although funds do not care about households at all, but they respond optimally to fund flows, which is channeled endogenously by myopic households in response to the aggregate shocks. So here, the endogenous fund flows acts as we call it invisible hands to connect these aggregate shocks who hit on the households and institutions' asset allocations and asset pricing behavior. And as a result, in this model is actually a very simple model. And in this model, the direct investors host the mean variance efficient portfolio, denoted by phi dt. It's just the mean variance we learned from Financial Economics 101. And the key thing is the fund manager's portfolio choice. They optimally deviate from the mean variance efficient portfolio because they want to hedge the flow risk. They care about flow. The flow will affect their AUM, and they are compensation dependent AUM. So you can see this is a fund manager's optimal portfolio holding phi m means manager t, and this is the mean variance efficient portfolio. This is the deviation. The deviation, actually the portfolio tilt here stems from this covariance between asset returns and fund flows, and this is what we call this flow betas. And more importantly, we show that the funds tilt towards low financial stocks more aggressively, which means in the cross-section, if you look at the deviation of the mutual funds or this fund managers' portfolios from the market portfolio, it is negatively correlated with the flow betas, which means if they will, for stocks with higher flow betas, those mutual fund managers and institutional investors, they will deviate more because they don't like those stocks with high flow betas. And this very simple result, just like the CAPM, is very elegant novel in the sense it is testable because the benchmark here, you can see it's a market portfolio, is observable, and this flow betas are estimatable. Okay. And based on this, as allocation, our model also implied that for any asset I with return, RIT plus RIT, so this excess return is not only due to the market beta here, but also due to the fund flow beta. So in our model, a conditional two-factor model emerges. And because endogenous in our model, this aggregate fund flows, they are endogenous driven by aggregate shocks, such as uncertainty shocks. If you plug in, you have something, asset pricing relation, just like this ACAPM developed by Bob Merton. So those are the main results. For the rest of the paper, we'll just test those implications. Okay, data. So we kind of combine data from various data sources for our empirical analysis. For the mutual fund data, we follow the literature, and so basically the sample span from 1991 to 2018 because the data before that has low quality. And we focus on active US equity mutual funds we also consider, following the literature, we also consider the intersection between the CRISP data and Morningstar data to construct fund flows and fund returns. Okay, so for robustness. So for any single piece of empirical analysis or results in the paper, you will say, side by side, the CRISP alone, the result based on CRISP data alone and intersection of CRISP and Morningstar data for robustness. And for the quarterly holdings of mutual funds, so before July 2008, we used Thomas data, and after that, we use CRISP data. It's just follow the literature because people argue that for the holding data, Thomas has a better quality before July 2008, and the CRISP has better quality afterwards. And in the paper, we also conducted 2 causal and natural experiments, and that also to do that, we also use the natural disaster data, and also each firm, public firm, headquarter zip codes, and their establishments, zip codes, and their establishment level sales. And we also need to construct the firm exposure to China using various data sources. Okay, so now let me jump into the empirical analysis. Basically, remember, we just test these 2 results. One is about the relation between flow beta and institutions as allocation. The second is the flow beta and the stock returns. So first, we need to construct these common fund flows. We construct this, we do this in the 5 steps. First, we construct AUM and the flows at the fund share level. In the paper, you'll see as robustness, we show that all the results go through if we aggregate this fund share level information to fund level, and we conduct all the analysis at the fund level. So here, but in this talk, I will just show you the fund share level result. And we define the fund flows based on the changes in AUM and the fund returns following this, accounting identity formula. But what do? We take a further step, because remember, the key thing in our paper is to think about this, focus on this hedging behavior, flow hedging behavior of fund managers. So to construct this pure fund flow shocks, we further control for the past relative performance of the funds and the contemporaneous return-based hedging motives. Basically, we run a regression. This is a fund flows. We regress. We control for this previous period relative performance and contemporaneous period component relative performance, and we have this time fixed effect and the residual. And we define the fund flow shock as the summation of the time fixed effect and the residual epsilon IT. Given this, at each fund, this I is each fund share level. Given this, we sort all these fund shares into 5 groups, either according to the quintiles of size or quintiles of age or quintiles of industry concentration. The paper we show is amazingly robustness. We have almost exactly the same result if we do different, we sort into 5 groups according to different characteristics of the funds. And then we extract a common component of fund flow shocks. How do we do this? Naturally, we do PCA. Why? Because here, I just show you one. You can see here we have Q1 to Q5. There's 5 groups of quintiles by fund size, fund share size. So you see this is the fund flow shocks for each group. They really co-move together. And more importantly, I want to emphasize the co-movement is at a higher frequency than business cycles. And also, I want to emphasize, so basically you can see there's one component going on. Later we'll do PCA to convince you there's one dominating factor driving most of the variations in all the time series. And in panel B here, I show you here is like scatter plot pairwise to further convince you is really this pairwise correlation is really high. So here is we plot the fund flow shocks of Q1 versus Q2 and Q3. You can see the correlations are like about 0.5. The p-value is really small. It's highly correlated. And also in panel C here, we show the pairwise correlation between Q1 and Q4, Q5 is also about 0.5, and the p-value is really low. Basically, the co-movement is very significant. And also further, we do this formal PC analysis. So panel A is the PC analysis sorted for the groups based on font size, and the panel B is the PC analysis of on-flow shocks based on the the 5 groups sorted in quintiles of font age. So you can see here quite similar, almost identical. The main message from here is yes, there's one dominating factor that drives almost all the fluctuations across different groups of the flow shocks of different groups of fonts. So very naturally, based on this, we can use the first principal component as a proxy, empirical proxy for the so-called common font flows. Okay, now given the common font flows we have, so we can test our asset pricing and institution asset allocation implications. So first, let's look at the asset pricing implications. So basically, we look at all the public traded stocks, and of course we exclude financials and utilities, and we using rolling window we estimate their font flow betas. We solve them from low to high, and we want to see whether in the data as the model implied, the stocks with high flow betas have high expected returns. Actually, if you look at the panel A, it's based on crisp data only, we have this significant result. And also we move to the intersection sample of crisp and Morningstar, we see exactly the same result. So hopefully this convinces you that's the case. But further, this is far from enough, because a control theory is a risk-based story, and also in the cross-section, to validate this risk-based story, we need to verify that it is due to persistent firm level characteristic, which is the firm's flow beta, persistent flow beta. So we do two things. First, we look at the post-formation access returns. So now in this table, we look like next month's stock return. So here we look at the post-formation much longer period, 1 year, 12 months. Whether significant difference in the access return still shows up. Yes, it is the case. And the panel A is for the crisp only alone data, and the panel B is for the crisp Morningstar intersection, because it's very robust. And also, I have now time to go into in the slides, but in the paper we also show the post-formation beta is also significantly different. So kind of verify this, kind of like enhance our result on this risk-based story. So another question is whether this flow beta, the asset pricing result based on this flow beta, is due to, can this be subsumed by other potentially more fundamental characteristics of firms? So a natural analysis for this is the fund Macbeth regression. So we look at this market beta and the fund size, book to market ratio, the fund liquidity beta, and this fund liquidity measure, and other betas to uncertainty measures. We control those. You can see the first row, which means it's still, the case, which means this high flow, the stocks with high flow beta has higher returns. And it's the same in panel B. We do the intersection sample of crisp and Morningstar. It's also robust. So, and also I want to emphasize the results are robust if we use double sorts, not use from Macbeth regression, double sorts and characteristics and the flow betas. The tables are in the paper. So it's very robust result. So now we move to this institution's asset allocation results. It's very simple, very intuitive. This is saying that the institutions, they don't like those assets with high flow betas, because those are, to them, it's like more risky. Okay, so if that's the case, we can, the stocks with high flow betas, if you look at this aggregate mutual fund holdings, which is WIT for stock that means mutual funds, divided from this market portfolio, it should be more negative. That's the case. So we say actually the stocks with as a whole, this institutional investor here, particularly the active equity mutual funds, they hold less those stocks with higher flow betas. And also, you may say here, this why we use this market as benchmark, because sometimes the funds, they have their own benchmark. So here we show that the results are robust if we use a self-declared benchmark of mutual funds to compute these portfolio tools. So here the difference is not based on market, but based on the fund self-declared benchmarks. So the result goes through.
Got 5 minutes.
Okay.
5.
So sure. So also we show that to understand the allocations, we want to look at this kind of like the correlations between flow betas and the other characteristics. Basically, we show the stock with higher flow betas, they tend to be smaller funds, smaller stocks, and value stocks, and the stocks with high liquidity risk, and the illiquid stocks, which means such association adds to the cost of exploiting the small and value strategies in the data. It's help us to understand this puzzling pattern in the data documented by Andrew Matrick and his co-author, and Martin and his co-authors, showing that the institutional investors, especially the mutual funds, they holding this kind of like that, they holding the growth and the large firms. They tend to hold significantly to that direction. Seems they are giving up those kind of excess returns. Why that's the case? Because here we provide one justification, because those stocks tend to be stocks with high flow betas, and the institutional investors, they don't like those stocks. And the last piece is we use natural experiments to further directly test this flow hedging behavior of the fund managers. The key idea here is very simple. Basically, ideally, we want to see the outflow risk of the funds goes up. The fund as the portfolio towards the low flow beta stocks will become more aggressive. But there's empirical challenge for this. First is the endogeneity issue. Basically, this, the change of outflow risk at the fund level and their portfolio changes may be commonly driven by some missing variables. And the second empirical challenge is the outflow risk is latent. We don't even have a perfect measure for this outflow risk at fund level. So how to do this? Our approach is we use reduced sum average regressions. First, we need to find a
3 minutes, Winston.
Yes, efficient, the powerful IV. The IV we use is the fund F portfolio share of stocks whose headquarters are located in the counties hit by natural disaster in quarter T. Okay, so basically look at all the funds in each quarter T. If this NDFT is higher, NDFT means larger fraction of this, the holdings of the funds actually hit by the natural disasters in that period. And we need to argue for this exclusion condition. Actually, this is a first one advantage of such shock is the exogenous and the idiosyncratic, and they are natural disaster shocks. But it's not enough. Further, we later you'll see in our analysis, we focus on fund portfolio changes among unaffected stocks. We even remove the affected stocks, the suppliers and customers, to kind of isolate this potential spillover effect. So hopefully we can convince you about the exclusion condition and also the relevance. The idea is that, if one fund, the bigger share of the holdings hit by natural disasters, it will have relative poor relative performance in that period. And in the extensively showed in the literature, such that poor relative performance will lead to high outflow risk in the following periods. Okay, so here in this table, we show the first stage results. Basically, we show that the funds with higher natural disaster exposures in quarter T-1, yes, in the same period, they have on average more abnormal outflows, and even for next quarter and the quarter after next quarter, but after 2 quarters, the effect is gone and is robust to different subsamples. But you may say it's not really first stage. Yes, you're right. So basically, what we really want to show is a risk in the following, right? The outflow risk. So we use 2 measures to measure the outflow risk. One is left tail risk of the fund flows in the following periods. The other one is dispersion of fund flows in the following periods. So here you can show, basically we sort these funds into low natural disaster exposure and high natural disaster exposure. We want to show for for the funds with high natural disaster exposures, their left tail of fund flows in the following periods actually is more negative. It's larger in magnitude. Actually, this is the case. And here, this panel shows for next quarter, and this table panel shows for the quarter after next quarter. It's still significant. And here, the result holds also for the dispersion of fund flows as a measure of the outflow risk. This is the first stage. Hopefully, I convince you about this relevance condition. And then we move to the final step. It is a second stage. So basically, this is a reduced form average regression for unaffected stocks. So given I'm running out of time, let me just summarize in words what this table means. It's just showing that the key thing is the interaction term. The idea is that the funds have higher hidden by this hidden by this natural disaster more significantly in quarter T-1. They will tilt more aggressively at the same time to more aggressively change their portfolios towards this low beta stocks, low flow beta stocks. So that's why you see the significant negative coefficients. And also the result is robust if you use Chris Morningstar intersection subsample. Okay, so let me conclude. So in this paper, we show the fund flows. First, we show the fund flow shocks obey a strong factor structure. And then we show this fund flow, this common component, conform flow is priced in the cross-sectional stock returns. A risk premium analogous to this ACAPM intertemporal hedging term emerges even in the myopic environment. And then also we show the fund managers, they really hedge fund flows by tilting their portfolios towards low beta stocks, low flow beta stocks. And that this will add additional costs for active, mutual funds or institutional investors to exploit profitable strategies such as value and small strategies. And more importantly, at high level, conceptually, the fund flows act as an invisible hand or central link connecting the shocks affecting myopia households and institutions' asset allocations and asset pricing in the capital market. Yeah, so that's it. Thank you.
Thank you very much, Winston. The discussant is Espen Henriksen from BI.
So yeah, thank you so much for being allowed to discuss this paper. It is really, really polished. So I don't have actually too much to add to it. My main comments will be on that the paper is pretty separate in the empirical analysis and the theoretical model. And it's not obvious why you need both, or why you need the theoretical model in order to support the empirical results. And then sort of discuss then, are all the assumptions really reasonable? Or could we relax some of these assumptions to answer more dimensions or account for more dimensions of the empirical findings? Anyway, so let me just start with just some data. So here I've taken data out from ICI through Ed Yarden's page. So here we see the weekly net cash flows from mutual funds. So this was actually pretty new to me, that the flows are so volatile and so large. What we also pretty easy can see here is that there were huge outflows, for example, in the fall of 2008. It was also large outflows in the middle of the European debt crisis. And we see lastly, if we move all the way back to early 2020, that what seems to be huge outflows also in March this year, when the uncertainty associated with the COVID pandemic was at its largest. So this is what these guys try to account for. What is sort of interesting is if we then take a 13-week moving average of the exactly same data, just to put things into perspective. And then so we remove some of this high frequency volatility, and what we see is this long-term trend. And what is pretty obvious when we compare the integral below the horizontal line with the integral above the horizontal line, is how huge the outflows have been compared to the inflows during the last 12 years. So, okay, active, so the 2 points, active funds have seen a huge outflow. The authors do not account for that, but what they do account for is how we adjust the portfolio or the asset or the strategy for the assets under management given this high frequency outflows. When I read up on this, I also actually came across that this is a seminal paper in the literature on mutual funds by Judith Chevalier and Glenn Ellison. And what they state that because mutual fund companies usually receive a fixed percentage of assets under management as compensation, they will have an incentive to take whatever actions to increase the total assets of the fund. In effect, the flow performance relationship then serves as an implicit incentive contract. And this is actually the core of this paper, is how can we stabilize, or how will fund managers behave or make their choices in order to maximize their compensation, which is a function of assets under management. So here is sort of the observations the authors are doing and the questions they are asking. So as I said, compensation of active fund managers is a function of assets under management. The change in assets under management can then be a function either of the returns you are able to generate on your assets or by exogenous in or outflows. And the fact that there's been huge in and outflows of these fluctuations make them ask the question. So in order to reduce the asset under management, and by that, the volatility of their compensation and their consumption, do active managers then tilt their managed portfolios to reduce the volatility of their AUM and also then of their compensation and their consumption. So when we are talking about hedging here, we are not talking about hedging directly on behalf of the households or of the endowments, but how do actually managers hedge their own consumption or their own consumption fluctuations. This is the object. So then straight on the empirical analysis, and this is all I have on their empirical analysis, but just to summarize it. So what they are saying is that, as Winston was saying, is fund flow shocks obey a strong factor structure, and the common fund flow combos negatively with economic uncertainty. And then the return sensitivity to common fund flows is priced in the cross-section, leading this to then this conditional 2-beta pricing model with market return and the common flows. And we then see clear evidence that active fund managers seems to hedge against the fund flow shocks. And then the authors write down a model that tried to rationalize these empirical findings. So these 3 really, really interesting and robust empirical findings. And then on top of it, we add an theoretical model that rationalizes these empirical findings. So in the model, we have 3 different decision makers. We have the direct investors that trade risk assets directly on their own accounts or policies. So these are sort of ensuring that we get market clearing, essentially. And then we have the fund clients who are, they can choose to delegate their investment to professional fund managers. And what these guys can then be either retail investors or institutions like pension sponsors, pension funds, university endowment, you name it. And then lastly, we have the fund managers who then control the asset under management of these active funds, and they consume then part of the revenue of the funds, or a fraction of the AUM, the asset under management. So here's a few of the really, really crucial assumptions. I think these are the most crucial assumptions. And the first crucial assumption in their model is that you have a two-period Olg model. And okay, when you talk about Olg model, you get this idea that this is going on forever with these generations. But what this essentially buys you is that all decision makers only make one decision at one point of time, and that these are in no way connected. So it's for all decision makers are extremely short-sighted. They're only making this one decision. That's one. So there's no dynamics really in the model. The second is that fund clients have no hedging motives. So the only ones who have a hedging motive is, and that's partly because, or the only way there's a slight hedging motive for the clients is through their like hardwire into the utility function, and how the uncertainty makes you discount the future with the Espen utility, but they have no consumption stream they want to hedge, or that would affect their risk aversion, or then the portfolio choice. Then third, there's a convex cost of active management. This is very much in the Burke and Green tradition anyway, but at least that it is here hardwired that it's more costly to manage a large fund than a small fund. And then lastly, the assumption is that fund managers' consumption, which then is so where these are for the two periods, so they make one decision for how much they should consume this period and how much they expect to consume the next period. And that would, for each period, be half of the fixed cost of management times the assets they have under management, their AUM. And then how do you then, what will AUM be next period? AUM next period will be partly due to what returns you are able to generate for the funds currently under management, and whether you get inflows or outflows. So these are four crucial assumptions. Then with
10 minutes, Espen.
Sure, very good. Thank you, Christian. So then here with the convex cost of managing funds, that will give a demand curve for delegation. And then we have the fund clients, their objective function that Espen gives the supply curve for delegation. Okay, the love story of economics, supply meets demands, we get equilibrium. And then here we will then have in equilibrium determine then both alpha, sort of how much alpha they would try to generate, and assets under management, okay, essentially the flows. And what they then will find is that the alpha the fund managers are generating, they will describe as counter-cyclical, whereas the flows will then be pro-cyclical. And then lastly, again, given straight to sort of the question I believe sort of is at the core of the paper, then from the fund managers optimization problem, we also find, so you see these two other things, they're coming straight from the optimization problem of the clients and straight from that convex cost. But from the fund managers optimization problem, we also get this incentive to partially hedge their future income. So then, and the risk then associated with outflows. So my questions to their question is sort of, does the model shed additional light on the results are the assumptions justifiable, or sort of could we think of a different model? And okay, so the model is super clever and interesting and intriguing, but I'm not sure whether it sort of leaves you with a feeling, okay, it's possible to write down a model that accounts for what we observe. And then that the assumption is pretty strong. So actually, I think that it is possible to write down a different model. And I spent the 4 last minutes trying to just sort of talk about that. So if we think about a different modeling approach, we could sort of account something that could account for dynamics and potential tensions between short and long-term incentives. So Winston mentioned in his presentation sort of how these the beta on the flows were loading on value and small cap. So then you see again there's a clear tension between, should you hedge these flows the next period if I'm totally myopic, or would you rather run like a more traditional factor strategy, or then loading up on small cap and value? So then you get the tension between short and long-term incentives. Then we may want to try to account for the joint distribution of portfolio choice, alphas, and then size, age, and flows. Maybe shed light on the convex cost of the management function. And also, instead of just sort of hedging for the sake of the fund managers, should we or could we think that this could also hedge on behalf of the clients? So in order to motivate, so these are some really fascinating figures from the paper. So these shows the mutual fund size by size quantiles. And what you see from this is that the smaller ones, for example, the blue, which is the lowest quantile, are both higher flows on average and way more volatile than, for example, compared to the largest funds, which is the green line at the bottom. If we see the same kind of figure with the age, we see essentially the same picture. So volatile flows for the young firms, large and volatile, much less volatile for the older firms. So could we then think about that if we say that fund managers have the same period per period the return function as in this paper, they return income from AUM, but then thinking about managing a small young firm is like a call option, which has a large upside but a capped downside. Then you will have large incentive to take risk and generate exposed alpha. Whereas if you manage a large old firm, there is almost symmetry between the upside and the downside, just because you hopefully are far away from actually going out of business. So then an incentive there is probably that to take risk and generate alpha to attract funds has diminished. Instead, they have the incentives in this paper to keep and minimize volatility of AUM. If we do something like this, if this is possible, I think also it could be that what you will get out is observationally equivalent to a convex cost of management. So it's sort of that you will, when you are large, you have a much less incentives because you can live well out of your AUM and your risks are symmetric. So you will behave as if your cost of management is much larger than what they actually are, whereas you will then do the opposite when you're small. Something like this could also then shed light on why we hedge for managers, but not for fund clients, which I actually am I'm genuinely puzzled about. More in general, not for this paper. So it's 45, then I should wrap up. So this is an excellent paper. So it's really intriguing and it's polished. I think the empirical findings seems they're both interesting and apparently, as far as I was able to find, really robust. There is, however, then that the model and the empirical analysis seems a little bit disconnected, and the model rather rationalizes the empirical findings. So so this is more of a question, but this is more what I got to, sort of whether it would be possible to write down a dynamic model that would jointly account for both strategies, alphas that we observe, size, age, and flows. Thank you.
Thank you very much, Espen. I would suggest that we probably first give the audience the chance to ask questions, and then as we go along during this part of the show, we might also come to a point where Winston probably replies to the comments made by Espen. So are there questions from the audience to either presenter or discussant?
So my question was, in your model, are the betas just an exogenous characteristics of a stock? So if you have a high or low fund flow beta?
Yeah, exactly. So this goes back to Espen's point too. So basically, in this paper, the main result actually is empirical. So we ran a model to get a way of thinking, okay, to demonstrate these intuitions. So the model is quite parsimonious and qualitative. That's why we make it as simple as possible. So here, this beta in the model is exogenous specified. But in the empirical, we showed clearly, actually it's very important, those beta are significantly associated with stock characteristics. For example, the stocks with high flow beta tend to be small, very intuitive, tend to be small firms, growth firms, value firms, and also those firms with high liquidity. Yeah.
So investors that don't care about fund flows, are they not able to fully take on the risk of those, I guess? Or is that what's behind this really? You know, like if there's a risk and there are investors who are equipped and willing to take on that risk, and it's small enough so they can sort of trade it away by taking on the risk and earn the risk premium, then
yes. In the general equilibrium, when the market clear, because the institutions, they don't like those excess returns. So someone can take advantage of this. Empirically, we kind of explore going to the direction. So who are the ones? We show actually the hedge funds and those more sophisticated retail investors, they trade against. Yeah. So when we show I didn't have time to show those tables in the slides, but in the paper you show when uncertainty goes up. So when those mutual funds, equity mutual funds, they kind of sell off those high stocks with high flow betas. Those hedge funds and sophisticated retail investors, they kind of buy in. Yeah, so they take advantage of that. You're totally right. Someone has to, because someone is providing this insurance, they gain this excess return. Yeah.
Thanks.
Yeah, thanks.
Well, I think coming back to Rüdiger's question, it might be worth for the two of you to probably have an extended chat on this. I guess I can guess the background of Rüdiger's question. So there might be some interesting ideas to exchange for the two of you. Further questions? So Winston, if you like to comment on Espen's comments, please go ahead.
Yes, first, thank you, Espen, for the careful discussion and going into the details of the model. All points are well taken. Just a few things to clarify. So first, yes, you're right. So basically, I totally understand your feeling about this disconnect of the empirical and the model. Actually, they disconnect in the quantitative sense that we did that on purpose, because in this paper, yeah, we don't want to have like quantitative model to explain, to match all these important patterns. That's an actually natural follow-up paper. So in this paper, we just want to bring up this key idea. This fund flows, they have common components, highly endogenous. Can act as an invisible hand to connect the households, the shocks affecting households and the institutions asset allocations and asset pricing in the capital markets. So I think the model just served for that purpose. And also all the simplification assumptions like myopic, we did that on purpose because we push to the limit. We make this everybody in all agents in the model as naive as possible. And we show even in such an environment, this kind of like, multi-factor and the ACAPAM relation emerge. So we just want to show this contrast. So that's the purpose. Yes, you're right. But to make this invisible hand, to be really careful about really what's going on, and we need to build like a full-fledged quantitative model. That's a follow-up paper to match, this quantitative match the patterns. And also you point out this very important pattern. If we look, we show actually the flows are more volatile and significant for young and small funds. So basically, if that's given this fact, actually, according to our theory, the mechanism, our channel should be stronger among this younger and the smaller funds. Actually, we did it carefully, but we put the tables in the Convex. It is the case. There's heterogeneity. Our channel is much stronger among those younger, smaller funds instead relative to the bigger and older funds. Yes, that's a great point. But the model, we cannot match this in the current version of paper. Yeah. Thank you.